Hello everybody, it's Doc, and today we're going to look at a stock that has peaked and appears ready to cycle down. We have a long position in this stock and we need to make some decisions, and I'm going to take you through my process. Let's talk about why I think Northrop Grumman is going to cycle down. From this chart you see the industrial sector is underperforming the S&P 500. This suggests money cycling away from the industrial sector and into the outperforming sectors above the line. This is a process we call sector rotation. Money moving from a sector will affect constituents in the sector. Northrop Grumman is a constituent in the industrial sector. NOC has enjoyed a very strong move up over the past 16 months, and it's likely there'll be some profit taken. This is evident in the topping pattern you see on the chart. This slide compares the performance of the S&P 500, the industrial sector, and Northrop Grumman. The green line at the top is Northrop Grumman, and you will notice in late April it made a sharp move down. Looking at the performance over the past month, which is 22 trading days, we see the industrial sector is lagging the S&P 500, and Northrop Grumman is lagging the industrial sector. This is a good indication money is moving away from the sector and the stock. So what price level could Northrop Grumman go? We will use a technical analysis called Fibonacci Sequence to generate lower price targets. Typically, we see the first move down is about half of the total move. We start the Fibonacci sequence at the highest price and move down until the 50% retrace line is lined up with the first major move down. This will give us estimates of the support and resistance levels below. You can see after the first move down, the stock moved back up through the first resistance level and challenged the next higher level. It reversed at that point and came back through the $316 level. It is now stopped at the 50% retrace level, which matches the first move down. If the price breaks this support, it will tend to move down and test the next support level. That level will hold, or the stock will continue down to the next support. So we see from this sequence that Northrop Grumman may go to $290 if it breaks the $302 support. If the price breaks $290, then the next level down is $272 and then $244. A full 100% retracement will take the stock from a high of 360 degrees to a low of 245. This would be a full stock cycle. That would put it back at the highs in late 2016. A 100% retracement is not unusual. So we're now at the point where we need to decide, should we exit the position or maybe there's another alternative. Northrop Grumman is an excellent long-term stock with a good dividend. Long-term investors would say that you just hang on to the stock because you expect it will come back in a year or two. Meanwhile, you collect nice dividends. Well, I've got a better idea. Why don't you get paid to sit through a cycle? Yes, get paid, make money. You keep the stock, you collect the dividends, and your statement doesn't get crushed. Now, let's look at the position we have and see what we've done to protect it so far. We own 200 shares that are up about 28%. But wait, our position is up 50%. How is that possible? First, we sold a covered call for $46.96 per share that obligates us to deliver the stock at $350 per share on January 17, 2020 if it's above $350 a share. We also purchased puts that give us the right to sell the stock, put it, at $325 if it's below that level on July 20th of this year. The stock is currently trading at $308.44, and we own the right to sell it for $325. We have a stock that we purchased for $242.70, and we have a guaranteed sale of $325. The covered call that we sold for $46.96 can be closed now at $20.15. This is a nice profit. Think of it this way. The covered call gives us $46.96 of protection. If the stock continues to go down, this option may expire worthless on January 17, 2020. That $46.96 is money we took in, and it would be worthless, so we get to keep all the premium. We paid $7.77 for the July 325 put that is now worth $16.75. If NOC continues to go down, this put will continue to increase in value. So the profits from the covered call and the profits from the protective put combine for a total of $7,146. This is what boosts our return to 50%. Now let's talk about our choices. First, we could buy the covered call at the July expiration and let the stock be sold, put, at $325. If we take this choice, we will not be eligible for future dividends on NOC. Our second choice may not be so obvious, but let me take you through it. First, the increase in the value of the put is offsetting the drop in the stock. So when the July option cycle expires, instead of letting the stock be put at $325, we sell the put for a nice profit. This profit will be equal to the difference between $325 and the current price. So we have effectively retrieved the loss in value below $325. We just got paid for holding the stock. It's important for me to mention something at this point. The protection cost you nothing. You took $46.96 and used $7.77 of that to buy the puts. Now your puts have nearly $10 of profit, and we will use that profit to buy another put to protect us through the next cycle. There is a lot more to this, but I'll stop here. You get the point. We're being paid to ride a cycle. You're making money, and it's not costing you anything to put this on. We will continue this process as long as we own the stock. Now, why aren't you doing this? Why isn't everybody doing this? The big institutions do it. Okay, it's a bit complicated, but why isn't it commonly used by the retail industry? If you self-direct your investments, you need to learn how to do this, and I can teach you. If you manage accounts in the financial services industry, you need to learn these techniques. I can teach you. If you have an account with a retail brokerage firm, you should demand that some type of active downside protection be used in your portfolio. If they can't do it for you, then I can do it for you. These techniques are used by large institutions every day. You should have the same active protection system on your account. So until next time, this is Doc saying trade safely and stay hedged.